In the mid-1990s, a hedge fund emerged that seemed untouchable, hailed as the brightest star on Wall Street at that time. Founded in 1994 by former Salomon Brothers bond arbitrage chief John Meriwether, long-term capital management quickly amassed a reputation for dazzling returns. Yet beneath the glitter lay a strategy of extreme leverage and complex convergence trades that few truly understood. How could a firm built on such brilliance begin to wobble on the edge of disaster? The answer lies in the very numbers that powered its rise. Meriwether had previously headed Salomon Brothers bond arbitrage desk, a unit responsible for up to 100% of the bank's global earnings in the late 1980s. After resigning amid a trading scandal in 1991, he gathered a cadre of former Salomon traders and, in 1993, created Long-Term Capital as a hedge fund, later incorporating LTCM in Delaware. This pedigree attracted Nobel-winning economists Myron Scholes and Robert C. Merton to its board, lending academic gravitas to its daring bets. Yet such elite backing could not shield it from hidden risks. The fund's early performance was spectacular. After fees, it posted annualized returns of roughly 21% in its first year, 43% in the second, and 41% in the third. By the end of 1997, LTCM earned 27% and returned capital to investors in the fourth quarter. Such success attracted over $1.01 billion in capital on its first trading day, February 24, 1994, and later a total of $1.066 billion from UBS plus $133 million from Credit Suisse First Boston. Could these soaring gains mask an impending fragility? At its peak in early 1998, LTCM's balance sheet read like a financial leviathan, equity of $4.7 billion, borrowed funds exceeding $124.5 billion, and assets around $129 billion, creating a debt-to-equity ratio over 25 to 1. Off-balance sheet derivative positions carried a notional value of about $1.25 trillion, predominantly interest rate swaps, while the fund also held large positions in equity options and merger arbitrage. Such staggering leverage amplified both profit and peril. What would happen when market tides turned against these colossal bets? The core of LTCM's strategy was convergence trading, identifying pairs of bonds whose price spread should revert to a predictable level, then betting on that reconvergence. Quantitative models projected these spreads, and when they widened, the fund placed massive bets expecting a return to equilibrium. This approach worked while markets behaved, but it left the firm exposed when rare shocks widened spreads beyond historical norms. Would the Asian financial crisis of 1997 and the Russian default of 1998 be the catalysts that shattered this equilibrium? In 1998, the fund's fortunes reversed dramatically. Within 4 months it lost $4.6 billion, a collapse driven by high leverage and exposure to the 1997 Asian financial crisis and the 1998 Russian financial crisis. Monthly returns turned negative, minus 6.42% in May, minus 10.14% in June, and roughly minus 10% in July. By the end of August, capital had shrunk by $1.85 billion, and equity plummeted from $2.3 billion at September's start to just $400 million by the 25th. How could such a rapid descent trigger a systemic alarm? The rapid erosion of LTCM's capital threatened to destabilize the broader financial system. Its liabilities exceeded $100 billion and its effective leverage ratio surpassed 250 to 1, making it a massive counterparty to banks worldwide. Moreover, the fund had become a major supplier of S&P 500 Vega, meaning its positions were deeply intertwined with market volatility. Regulators feared that an uncontrolled unwind could cascade through illiquid markets. What steps did the financial establishment take to contain the fallout? On September 23, 1998, 14 of the world's leading banks, under the supervision of the Federal Reserve, orchestrated a $3.65 billion recapitalization to rescue LTCM. The agreement injected fresh capital, reduced the fund's debt, and granted the banks a 10% stake in the reorganized entity. Partners also contributed $1.9 billion of their own money, sharing the risk of the bailout. This unprecedented private sector rescue averted an immediate crisis, but it raised questions about moral hazard. Did the rescue truly end the fund's peril? Despite the infusion, LTCM could not recover its former stature. The fund was liquidated and dissolved in early 2000 after a protracted wind down of its positions. Audited by Pricewaterhouse LLP, the final accounting confirmed total losses of $4.6 billion. The episode left a lasting imprint on risk management practices, prompting banks to tighten leverage limits and regulators to scrutinize systemic exposures. Yet the story also sparked debate among economists about market efficiency and the limits of quantitative models. What legacy did LTCM ultimately impart on Wall Street? James Surowiecki later observed that LTCM had grown so large in illiquid markets that there were effectively no independent buyers, rendering price discovery impossible for assets like Danish bonds in September 1998. This concentration meant that when the fund faltered, markets could not absorb its unwind without severe distortion. The episode thus illustrated how a single, highly leveraged entity could undermine the very wisdom of the market it sought to exploit. Does this cautionary tale still resonate in today's era of massive hedge funds? From its meteoric rise to its dramatic rescue, LTCM's saga began with a question: how could a fund once celebrated as Wall Street's brightest star collapse so swiftly? The answer lies in the combination of extreme leverage, reliance on convergence models, and exposure to unprecedented market shocks that turned profitable spreads into catastrophic losses. While the 1998 bailout halted an immediate systemic panic, the fund's dissolution reshaped risk oversight forever. Yet the memory of a $3.65 billion private rescue still haunts regulators, reminding us that even the most brilliant strategies can falter when the market's equilibrium is shattered.